Jason, I have one quick question before we really dive into this. Is that playing in your background?
I'm at an undisclosed location. Somebody could really dive into that blur. They could really figure out what's playing on the hotel TV in the background.
Let's rock into it. Welcome everyone to the Pirates of Finance. Once again, not live. We apologize. Summer schedule is going to be a little tough for us. We're dancing and weaving here trying to get this all out. But those of you tuning in at the live time, this is the premiere, so thank you for tuning in. We appreciate it. We are your hosts, the handsome man across the screen from me, coming to you in a beautiful 1080p. Not wearing his pirate sweater, though. The most apparent thing I can see.
I packed it though too. I packed it. I'll let you finish the intro. I'll let you finish the intro.
Clear in 1080p that you don't have the sweater on, despite the fact we don't have a time constraint for this. You could have said, "Give me 5 minutes to go get my sweater," and yet you said, "Let's just go live without it." Well, that is Jason Buck, and that tells you maybe everything you need to know about him. He walks to the beat of his own drum. My name is Corey Hofstein. As you can see, I am wearing the uniform. Much more likely to conform with regular norms. That's everything you need to know about us. Look, this is the show where we talk a little bit about everything: markets, finance. We shit on macro. We go off on random tangents, but it's certainly not advice of any kind. As I've been known to say, not financial advice, accounting advice, marital advice, spiritual advice. Seek professional help. Don't take your advice from two random guys chopping it up on the internet.
I'm going to be spending a lot more time in here with you lot because I love it in here. I fucking love it.
I was invited by Dean Kernut, who is the host of Alpha Exchange, which we've mentioned on this podcast.
Oh, yeah.
I think is easily a top 5 podcast for me. It's one of my favorites to listen to. He is a incredibly professional host who gets some amazing guests on there. I highly recommend if you're into institutional and quantitative investing, derivatives, that sort of stuff, go listen to Alpha Exchange. He was hosting a conference that was about raising money for different charities dedicated towards supporting education for underprivileged children, and he got some heavy hitters not only in the panel but like in the crowd. I'm just like walking through the conference and I'm like, oh, it's Rocky Fishman, who was at Goldman Sachs and did all their options derivatives work, now out on his own. Dennis Davitt was there. Chris Sidiel was there. John Laughlin was there. Like, I'm just in this. They're just people in the audience. John Sabat from Point 72 was there. Like, these weren't people speaking. They're just sitting in the audience because Dean asked us all to be there. So it was kind of weird. It's like, oh, this is actually surprisingly a large number of like heavy hitters in the industry just here to support Dean and support the mission of whatever's happening. And then you had a couple great speakers. So Cliff Asness was there, for example. But the one I wanted to talk to you about was Ross Stevens. Do you know Ross Stevens?
Remind me.
So the only reason I thought you might know the name, I wouldn't expect you to know the name. So he is the founder of Stoneridge. Stoneridge Holdings, I think, is technically the name of it, but they were the ones who really pushed the use of the interval mutual fund in the early 2010s to bring to market things like cat bonds, catastrophe bonds, and be able to make it so that this sort of independent asset class could be brought to market. And he had a really fascinating talk. His talk was basically all about how his whole life has been informed by he went to Chicago Booth at the time. He just made a very large charitable gift. It's now called the Stevens School. And he was under Eugene Fama, just as Cliff was. I think they were there around the same time. Cliff has written some papers with him. And he said, the thing that has most influenced his life is not Eugene's work on the efficient market hypothesis or the factor models, though that was important. It was his work on the principal agent problem. And how all this stuff that he's done in trying to find business solutions is about solving this principal agent problem, which I thought was pretty fascinating. And in particular, principal agent problem that that unique data sets could solve for him. So some of them are more obvious, and I don't want to go on. This was an hour-long interview. I could take a whole hour discussing it, but there were a couple of really cool examples he gave, both on the data set side as well as the principal agent problem side, that I just wanted to put out there because I think you'll find them interesting, and I think it'll lead us to talk about some cool stuff. So one of the things he talked about was the question that came up for them was, what is the actual return on fine art? It's an interesting open question. How do you even calculate that? Well, back in the 1960s, the Center for Research of Stock Prices was formed and started collecting stock prices and allowed people to answer the question, what's the return on stocks? Prior to that, you couldn't actually answer what's the return on stocks. Once you start collecting the data and maintaining that, you can start to ask some really interesting questions. So his team went back and found as many auction houses as they could around the world, both currently in existence and those that have gone out of business, and went through all the whole old transactions, which involved going to libraries and like getting books and typing it into databases by hand to build a master database of art that has gone to auction and what it's sold for. And what was really fascinating was that the primary categories they had now were based into time periods. So like the old masters would be like, I don't know, your Picassos, for example. And then it was like sort of as it went through time to your new modern era paintings, which I think it was all post-war, 1960s and after. What was really interesting was there was a monotonic increase in the return of the paintings. So like if you buy an old Picasso, your expected annualized return is like 2%. Mm-hmm. If you buy a modern art piece, your expected annualized return is 18%. But the fucking variance in the prices is wild, right? So a very cool example of like how like unique data set, right? That other people don't have, that allows you to start to ask some questions and maybe build some product. One more second, because I'm going to tie this into the principal agent problem. So the next one he talked about was baseball. And he talked about building a database of WAR points. So what is it? Wins above replacement is the very popular baseball statistic. So for every player, building this database of wins above replacement, and then looking at expected lifetime compensation for early players versus later in their career. And what they found, baseball is very interesting because when you come into baseball, in your first, second, all the way through your sixth year, you pretty much have a capped salary. It's not until you're at your sixth year that you go free agent and all of a sudden you get the $200 million deal. But what they're able to do is say, this first year player is absolutely expected to earn $150 million in their career. They're only making $1 million their first year. We'll make them a loan for $10 million right now, right? And in making them a loan for $10 million, it's non-recourse. We just get a payout of their future earnings. We get some share of their future earnings. And so they've started this fund, basically, that's sort of this debt revenue share of baseball players, because they have this unique data set that allows them to forecast the future earnings of players based upon all the data they've collected. They've also done the inverse for team owners, which is to say, how do you insure against a player underperforming? There's disability insurance, but disability insurance, I guess, requires the player being sidelined for 60 games. Like there's very specific requirements. What they've started doing is saying, what we will do is actually, if we expect this player to be a WAR 6, if he drops to a WAR 4 below, we'll pay out. Right? Your pay-in premium is 2 WAR points. If he's 4 or below, we'll pay out. And it allows them to have an estimate of how much the player should be worth, allows them to insure disability against specific star players, and start to work with teams to offer actual performance insurance. Now they've only written one contract on that, but I think it's a really interesting use case of like, again, unique data being used to create an independent asset class that no one else has created in the past. I know that was a very long spiel, but I thought it was one of the most interesting conference talks I've ever sat through for something I figured would be a throwaway conference.
Yeah, it was so long. I have multiple notes, so hopefully I can go back over them. One is it remind me Todd Bowley of Eldridge, who bought Eldridge Industries, that bought Chelsea Football Club. He's been working on insurance for getting relegated from the Premier League in soccer. We've talked about that before, as like those parachute payments and how it can absolutely kill you economically. So he's been trying to structure products around insurance against getting relegated that remind me of. It also reminded me of, so this is a different firm than that was doing the they were giving loans to players in the minor leagues, right? And kind of doing a residual income over their career, that they were trying to like buy basically players in the minor leagues. Which is very different, I think, from what you're saying.
I think it's the same firm because
you think
yeah, I think it's the same firm because he talked about no matter how good a player you are, you typically have to do a year or two in the minors. And so they can sort of find the players in the minors and say, we know, I guess it basically like for every war point, it's about 12 million in expected future contract value or something like that. And so they could say, okay, you're in the minors, you're a 7 war player. We think your expected earnings are 78 million or something like that. We will give you $10 million right now.
Very interesting. And then we've talked about in the past how like the player cards are set up in soccer too. Like when a team makes a deal for a player, they're paying for the player card and then they have to negotiate the player salary separately, and how those can get astronomical. But it's been interesting. People have financed those player card purchases for the clubs now, where they own the player card. And so they figure out the financing structure around that. But don't you think there's like, I always think when you're starting to say that, it's like, as soon as a player hits that, like the contractual time when they can renegotiate as a free agent, and they hit that like 150 million, $200 million salary mark, like to me, like you're saying, that's why I'm really interested in the insurance after that, because it's like a negative selection bias. Aren't most, like usually it's like the Yankees in baseball, right? You're buying, at the peak of that player's probably potential. Similarly with like the player cards in soccer, like PSG out of Paris is going to pay, extraordinary amounts for like a Messi or a Neymar or Mbappe. And, it's likely, the likelihood for them to be able to outperform a $200 million purchase is relatively small, wouldn't you think?
Well, I think it's a question of what are you trying to get out of it, right? If you have the $200 million purchase and you say, okay, this person is going to drive ticket sales, it's going to drive TV watching, it's going to drive jersey sales. I saw something, speaking of Messi, and I'm sure you have thoughts.
I was going to bring it up. Yeah.
Because this is a really interesting case of thinking about how you get equity and different stuff. But I saw this amazing stat that said Messi sold more jerseys personally last year than jersey purchases of the entire American MLS combined.
That wouldn't surprise me at all. So we'll get in the Messi in a second. Like, for example, when Juventus bought Cristiano Ronaldo from Real Madrid, their jersey sales like skyrocketed so much, and their social media following skyrocketed so much, everybody thought they overpaid. They turned out they dramatically underpaid, and they figured that out in the first week. And then subsequently, he's gone to Saudi Arabia, where they paid him $250 million for 1 year. So that's the rumor. What came out with Messi recently is that Saudi Arabia offered him upwards of $1 billion for 2 years to come play in Saudi Arabia. He's 35 years old. I think Ronaldo's close to 40 or right around there. But it turns out the coup of all coups, Inter Miami, David Beckham's club, just signed Messi, and he's going to be going to Inter Miami, even though he's like getting older, but he's not peak performance. So there's a lot of other things go into that, as far as like he had some issues in Barcelona where they kind of screwed him a little bit in that last week. And so he had to move his family within 1 week to PSG to play in Paris. And apparently his wife and his family were very upset about that move. So he says that's why he did not take the Saudi Arabia contract, because he didn't want to do that to his family again. And then also, people may not know behind the scenes, like his extended family and everything is apparently getting threatened back in Argentina, where they're like blowing up grocery stores they own and things like that. So I wouldn't be surprised if his Miami,
what?
yeah, I don't know, extortion, whatever, how like it can happen like that. So that's why I wonder if the move to Miami is also a way for him to also bring his extended family kind of like to Miami and everything, where they're much more comfortable in that pseudo Latin American setting of Miami than they would be moving, anywhere in Europe or anything like that. So like, obviously we're not inside the mind of Messi, but it's just been a fascinating kind of week.
Clearly Miami could not pay, right, what Saudi Arabia was paying. And maybe there's a certain point where you say, whether I get paid $1 billion or 500 million, like that, there's obviously a huge gap there. He just might not care, right? There are other factors that come into play of, I don't want to be there. I don't want to move my family. I need to protect my extended family. But what was really interesting was the way he was able to structure a deal that had important residuals, right? He's getting a slice of, and correct me if you have a better understanding of this, but he's getting a slice of the revenue earned by Apple TV.
That's the rumor.
The
Yeah,
MLS games, right?
So that's the rumors. Those that don't know, they just recently signed an Apple TV deal to show MLS games. So allegedly, he's getting a slice of that TV revenue. Allegedly, he's getting equity ownership in Inter Milan Football Club that David Beckham owns. And then allegedly, the price of tickets went from like $27 for home games, like $327, like overnight. And they still don't have a stadium, which is another issue there. But this is kind of similar to, I think, David Beckham, ironically owning the team, is the one that set the precedence. When he signed with LA for those few years, one of the parts of his contract was that he could at any time start up an MLS club, I think, for like a $50 million investment. And I think they're up to like $400 or $500 million now if you want to start a club. So that's why he was able to start Inter Miami for $50 million. So, you know, there's all these sort of like extended or ancillary negotiations that are obviously going on around, you know, bringing Messi to Inter Miami.
Yeah. Do you know how long his contract is for?
I have no idea, but you know, you can always, you know, break these contracts, renegotiate everything. So I was actually going to, another interesting kind of way to talk about this is on my flight here, I kind of read the first half of the new book Chaos Kings about tail risk managers. Obviously, you and I had to hire the PR firm for Universa because the entire book is apparently one just big PR like biography of
who wrote that, by the way? Who wrote?
Was it Patterson, the Wall Street Journal? Is it Scott Patterson, the Wall Street Journal reporter? But basically, it's like it's the story of all the players at Universa, from Taleb to Spitznagel to Brendan Yarkin. There's a little bit so far in the first half, and I shouldn't speak on it because I've only read the first half. Is Sornet gets sprinkled in there a little bit with his Dragon Kings and predictions. But the reason I bring it up is part of that story was when Spitznagel was living in LA, he met some producers and he was trying to figure out like the residuals to directors and actors, and how usually, you know, movies don't make it big, you know, the residuals are essentially worthless. But so he was trying to like buy residuals and create options on residuals. And it sounds like he pulled the plug at the last minute because he was going to work with Kavanaugh at, what is it, Relativity Media was Kavanaugh's business, where at one point he was kind of the darling of trying to bring, you know, Wall Street to Hollywood, and he was running Monte Carlo simulators on how a movie would do. But then later on, he was allegedly, you know, committing some fraudulent stuff, allegedly. So that was just an interesting side note in that book. But before I get maybe more into that book and some other pieces of that, do you have anything more you want to talk about your New York City trip and Dean's conference?
No, other than to say, great conference. Congratulations to Dean. Great cause. Again, it got this conversation with Ross Stevens got my brain really churning. One of the things, and I had assumed this incorrectly, I knew about their interval funds. I knew about their work in catastrophe bonds. And one of the questions I always had was, how is it just not that shit rolls downhill? Like Swiss Re is like, they're not giving away their best cat bonds to this small asset manager, by the way, who's not small. They manage like $40 billion. But I'm thinking to myself, like, they're not getting first cut here. They're getting the stuff that's being pushed out by these reinsurers. As it turns out, and again, I totally didn't have this understanding, and this has totally flipped my understanding of how their business works. They outright admit they have no idea which bonds to buy, and they don't want to have that asymmetry of information. And so what they've done is they partnered with all the biggest reinsurance firms and agreed to buy a pro rata slice of whatever the reinsurance firms are taking on. And so they basically said they're in a weird way like outsourcing the sub-advisory capacity, saying, okay, you big five partners will pro rata slice with you and assume you guys are doing all the work because you're wearing the risk as well. And so they're getting access to the right bonds in theory. Again, do your own due diligence if you're going to look at these funds. These are all very unique things. But the structure by which he's trying to build this stuff, I think is very smart. Built their own database of all the cat bonds as well. I think there's a real lesson here with how successful his business has been in going, what can you do with a unique database, especially when you find like a principal agent disconnect or an information asymmetry disconnect that allows you to use that data in a way that's takes advantage of a market.
So I think it's interesting on several levels. So basically, that's like a co-investor model. Like large institutional investors will work with PE firms, but they're saying a certain size. Like some of it will pay fees on, but otherwise we want to co-invest with you. And it's a way also for those PE firms to be able to source some dry powder pretty quickly. So it's an interesting way, especially if the firms have to wear the risk. Then it's understandable why they're cutting down on due diligence. Where even in PE and VC, sometimes they'll just use McKinsey or whoever to like not even do their own due diligence. But the other thing, as you know all too well, why you probably bring it up too, is like I spend a lot of my time on vehicles, and I've spent the better part of the last few months or year really diving into interval mutual funds and trying to learn as much as I can about them. There's not a lot of information out there, but what I would predict is the trend is going to be for more of them. They seem to be really heating up, especially because you can put let's say, not like less liquid products in there. Like you're going to see a lot of debt, credit, real estate funds kind of being rolled out in this interval mutual fund structure as debt and credit are getting exciting again for people. And like you said, cat bonds is another one that tends to work well because you can have this, it's a hybrid between a closed end and an open end fund. Basically, it's a closed end fund that you open up, let's say quarterly. So, and then the liquidity is not as large on the back end. So you can do much more interesting things with that potential vehicle.
Yeah. Just for full clarification, it's a mutual fund structure that you can limit when people come in and when people exit. And I believe the regulatory minimum is you have to let 5% out every quarter. I believe
not necessarily. I think that's what most people end up around there. I think the minimum is still 5%, but it's not necessarily quarterly. So you can determine if you want monthly, quarterly, or annual. And then you can let out more if you want. Like you could set it up so monthly they have 25%.
But my point is, it's a pretty brilliant thing if you're trying to manage less liquid stuff. You can say to your investors, "I'm sorry, we're only letting 5% out during this window period because the market's locked up." Yes, is there a bit of an incentive for the manager to just always, lock it up? Yeah, you never want money redeeming. That said, it's a great way to blow up your reputation. So you would think in theory they'll hopefully only use it if they care about the long game of their brand reputation to just protect the portfolio from some sort of, illiquid bank run equivalent.
Yeah, but if everybody knows that going in, then it's fine all the way around. The problem was historically, if you used a liquid wrapper like an ETF around like illiquid strategies and then you gated it, people were very upset. But at least if everybody knows caveat emptor going in, this is the way the structure works as far as liquidity and pro rata coming out, then everything should be better, like you said, especially longer term. So a couple of things you also made me think about was, did you see you happen to see Cliff Asness interview on Bloomberg with David Rubenstein?
I did.
And so one of the things I wonder what jumps out with you, besides that his early professors at Wharton recommended he go to University of Chicago. They're like, "Shh, don't tell anybody we told you this. We recommend you go to Chicago." And like you said, he worked under Fama, even though he disagreed with him. But what I'll get to, auspicious timing was the most interesting thing for me with that and this Chaos Kings books too, with like Universes. Like Cliff said, they launched with $1 billion, which first of all, man, you and I went the wrong route in this business. If you could launch with $1 billion, but they said in the first year they were down to $500 million. And yet they've still now succeeded to be one of the largest firms like in history.
So they launched, I only know this because Cliff just sort of talked about it at this event, and I just watched that interview. So they launched August 1997, I believe, or right before that. They were a 22 vol long short equity fund. And I think the market was down 7% that August. They did okay, but then obviously in the .com run, they got crushed. And he says it was a good lesson to him because allocators understood, and they had the right allocators, but some of them said to him, "We wish you just run a low vol version." He said he remembers doing a road show where someone would say, "I wish you just ran an 11 vol, a 10 vol, or 1/4 of the vol." And he said to them, flippantly but correctly, well, just give me 1/4 of the money. Give me half the money, right? If you want me to run it at half vol, just put half the money in. And that's how it works, right? And that's the right way to do it. You would pay half the fees for half the vol.
Right.
Now, it requires the investor putting the rest of the money in T-bills, which kind of optically doesn't look good. But Cliff's not wrong. Like, he should run the high vol version and everyone should just scale in. But I think for him, it was a very real learning point about line item risk, right? And just, you never want to be the sore thumb that sticks out. Now, I think there's also a lesson there of stick-to-itiveness, and they did not change their strategy, and they did not change the vol level. So when markets turned around, they were able to pick it all back up. But yeah, talk about shitty timing for what they were doing. Pretty bad.
You and I have had this conversation many times privately about how people just don't understand capital efficiency. I'm not sure they don't understand as much as they don't want to, especially at an institutional level, because everybody's trying to protect their seat, right? It's CYA. And so how many times I talk to institutions that are like, well, I want you to run, a single digit vol. And I'm like, you realize you're paying double the fees per unit of vol. And they're like, no, I don't care. Like, I just want, like you said, you just want to hide out there at this low vol, like multiple, where, when I look at managers, I'm like trying to get the highest vol I can, and then I can attenuate the position size to the rest of my portfolio. But people just don't seem to get it.
I think it all the time with high vol managed future strategies, right? You get these different managed futures funds in mutual funds. Some are high vol, some are low vol. And it's like, okay, you don't like the high vol thing because it has lots of swings. But what you really should be looking at is like, what's your total fee for the vol you're paying? For some of those high vol funds, you're actually paying less per unit vol. So you should, if you want a low vol version, just put some in cash and then put half the allocation in the high vol thing, and you're net better off from a fee perspective. I just think sometimes that math is hard to play through. Like, people want, if they want all that money in managed futures, I don't think they like seeing half of it in T-bills. They want it in the fund, which, by the way, is just holding fucking T-bills.
Exactly. They're just giving the manager a bigger T-bill position. Who holds the T-bills? It's like who's got my cheese?
Yeah. So it's sort of funny. By the way, a little bit of a funny story, and this is gonna sound like humble bragging, so I apologize beforehand. But I think I've quote-cepted Cliff somehow. I think.
Oh, nice.
So a while back, not that long ago, a couple months ago, he was on Masters in Business with Barry Ritholtz, and he said something that I really liked. He talked about this idea of statistical time, that basically people look at a back test and they're like, a 0.3 sharp strategy should be able to have a decade-long drawdown, and they look at the back test and they go, I could live through that. And then as soon as that drawdown happens, right, they can't live through it. The actual statistical time feels very short. A decade-long drawdown is very normal for a 0.3 sharp strategy. And then, so my spin on it was, I think I said something to the effect of like, behavioral time is different than statistical time. And I cited Cliff, saying, I love this idea of statistical time from Cliff. Well, I think he saw me do that on Twitter and then came to believe that I had come up with the quote. So he's now gone around citing me as the person who incepted the quote. So I actually, before the conference, was able to sit down and grab coffee with him, and I said, Cliff, I just want you to know that's your quote. Like, you've now multiple times given me credit for it. And so on the panel that he was there, he brought up this idea. He said, I've been fighting with Corey about whose idea it originally was. So I had to go back to the Masters in Business transcript, and I sent it to him. And I said, here's the highlighted part. I was like, I submit to the jury Exhibit A. This is your quote. Like, you don't need to quote me for it anymore. But I think I've just said so much
Cliff would
shit.
argue, yeah.
I think I've said so much shit on Twitter at this point that people are just like, Corey must have said that quote.
Yeah, only you and Cliff are arguing, not that I said it, but you said it. No, you said it. No, you said it. It's like the Spider-Man thing, like they're pointing at each other. But then even, I think one of the recent past episodes, we talked about our buddy Chris Abdul-Masih that wrote the great series on variance time. And then I always think about it as like Chronos versus Kairos, right? Like time speeds up, right, when you're trading. Yes. And so it's dealing with all those things, which is a great way to think about, once again, like Universal or these Chaos Kings. Is like, I think about the auspicious timing of Universal while I was reading that. Is I want to say, and I might not get the exact dates right and the exact numbers right, but they're going to be like directionally correct. I want to say Empirica was founded by Taleb, and they brought like Spitznagel on as a partner in like 2000. So they like kind of caught like the end or somewhere in the middle there of the .com blow up. So they did well there, right? Trying to hedge. Then around 2004, Taleb was tired of running outside money and dealing with this stuff. So they shut it down in 2004. 2007,
Writes the Black Swan.
Spitznagel, yeah, well, he writes the Black Swan, but Spitznagel and Yarkin spin up Universa in 2007.
Yeah.
Right to catch 2008, especially Q4 2008.
And then you've got an advisor who says rare shit happens, and 15 minutes later, the fucking rarest shit in the world happens. Like, I mean, you could not time that better.
Well, that's what they talk about in the book. It's like since the 80s, allegedly, Taleb and even Spitznagel and others have been talking about this stuff, but nobody cared, right? Until you time like the Black Swan book with the 2008 Black Swan, which they would argue is a gray swan. And then this is how now since 2008, they haven't had to market really since, or people haven't really had to, they've had too much trouble marketing. Like to your point, this might be hopefully directionally correct. But I think they said they made $1 billion for clients or protected, $1 billion in 2008. But then by the end of 2008, early 2009, they're managing $4 billion in, notional value of assets under management, because like I've experienced as well, it's like everybody wants insurance after the flood,
after the crash.
Right.
And so they bleed out of the insurance, right, and then the crash happens and they want it again.
Yeah, I'm sure the second half of the book's about CalPERS. Yeah.
That variance clock idea, I feel like, is one that when people first learn about it, sort of blows their mind. Ironically, and I don't think this is alpha or edge that I'm giving away, like that was a core founding principle of my firm 15 years ago. I didn't know it was called a variance clock, but I was working on trend following models that the core idea was, why would I look at a fixed period of time, like a classic trend following model, a 200-day moving average or something like that? The market reacts to information. We have imposed this calendar period on it, but during periods in which there's more information, price discovery happens very different than periods of less information, right? Months in 2008 were more meaningful to market prices than entire years prior to it, right? And so the innovation, if I had any, if I could be so bold as to say that, of what I tried to do originally with my firm, was that trend following should not be done on a calendar clock. It should be done on something akin to a variance clock. That, and this is something, I guess, that's more like vol people think about variance clocks a lot. High frequency people think about tick clocks or volume clocks. Like the idea being, and so if this is for people listening who have no idea what we're talking about, the basic idea is like price. We typically plot price over time of something. Imagine if it wasn't over time. Imagine if every time volume traded, you added a new candle or whatever for every 100 lots of volume traded. And so if a ton of volume trades in a day, you'd get a lot more candles printed. If it's a very low volume day, you get very little candles printed. You could do that with ticks, you could do it with volume, or you could try to translate that into a percentage move, and that would be something akin to a variance clock. In the world of implied vol, this is obviously very important, right? There are days in which you would say that's a large event day. There's a huge amount of vol in that day, and other days in which there's not. And so I think this idea of a variance clock, when people sort of learn about it, I think it helps them reshape maybe how they look at data and how they weight data. And I think a lot of ways in which naive weightings work is sort of a crude approximation of this much more sophisticated concept.
Yeah, I think for you and I, because we delve into futures and volatility and all this stuff, it's almost like burned into our bones at this point. Like you just see it happen all the time, so it just becomes part of your ethos. But I was like, do you think with like rebalancing timing luck in a way, another version of that, do you think like Harry Brown's rebalancing bands is another way of using like a variance clock versus like a timing clock?
That's interesting. Walk me through your thinking there.
Well, because essentially he's saying instead of rebalancing on a calendar schedule, wait till you hit these bands. Like if you have 25% in each, wait for it goes up or down 10, and then that's when you rebalance. And so that's essentially saying when vol or variance is increased, that's when you want to be rebalancing.
Yeah, I think that's right.
It's stretching, but
yeah, because it's not like I would say it, how would I think about this? Like if you were actually rebalancing on a variance clock, right? You could have variance accumulate and not have them drift far apart.
Right. Yeah.
Right. So it's not perfect, but I get what you're saying, which is like a certain amount of relative vol has happened between the two to drive the prices far enough apart. That's when you should trigger a rebalance versus arbitrary calendar choices. Yeah, I think there is a degree of similarity there that I think is a natural connection.
And then we like to play the game like who said it first, like you were just doing earlier. It's like, okay, then do we go back to Tolstoy? And then before that, if we keep going back, I'm sure back to like Heraclitus that talked about variance time as a pre-Socratic, right?
I mean, look, I've just decided all quotes started with me. So
there we go.
If anyone wants to cite a quote, you can just give it to me.
Well, you could start with, just, the world starts and ends with you, right? When you were born and when you die, that's it. That's the only world you know.
We talked about it in the past, social gamma, which I absolutely didn't come up with. Someone cited me for that the other day. I just say enough shit. And then I do adamantly say I did not come up with this. But I think people just like, well, I heard it from Corey, so I'm just going to end up citing him. I've had people like I feel bad for Rodrigo who came up with the phrase return stacking. People have been like giving me credit, and I go out of my way to make sure he gets credit because he came up with it. When the history books are written, if we're successful, unfortunately, it'll probably just end up being me because I just have a more public persona. I'm sorry, Rodrigo. I really do stress that it was you.
Just so you know, behind your back too, I go out of my way to make sure everybody know it came out of Rodrigo, not you. Just
I appreciate that. That's at least in line with what I'm trying to do. But that also means if it doesn't work, he's going down. It's his fault.
Exactly. He's got to wear that risk. Yeah. But like every good prognosticator and every good person in finance, you just throw enough spaghetti at the wall, and eventually, like it all trails back to Corey, right? That's what we're trying to do.
Yeah. I think the real problem is if you're around in the industry long enough and you write enough or you're on Twitter enough, you probably end up just saying some shit that sticks every once in a while.
Which has also shown you survived, right? And we always talk about surviving is the only success. To copy a phrase from Meb Faber, but I'm gonna pretend like it's my own as well.
Yeah, it's now your phrase. Sorry, Meb.
Sorry, Meb. It's gone. Do you want to address? Speaking of Cliff, I saw on Twitter, people once again were maybe bringing up, or like the flagship fund did incredibly well in 2022, but then people will bring up their long-term CAGRs, like maybe low single digits. And once again, almost like
exactly
auspicious timing. I'm just saying, I don't want to address that, but I'm just saying, like, as far as auspicious timing, we talk about a lot of different things that affect your ability to run a financial firm. The other thing is AUM. So my argument would be at AQR's AUM, like expecting them to have any sort of outsized returns is just not going to happen, right?
So to add a little context here, and I'm not going to bring up names because it's just not worth it, but someone who runs models, this is an anonymous person, but they've been writing a lot on Twitter for a long time, highlighted the equity market neutral fund that AQR runs and pointed out that the excess returns above T-bills really weren't that great on an annualized basis since it's gone live, and sort of said, what are all the PhDs doing? These returns suck. And I think it's a disingenuous thing. Maybe it's not purposefully misleading, but it's ignorant at best. Because what you have to realize with these strategies that are packaged up in a mutual fund is that even if they're doing their damn best, they tend to be sort of 0.3 to 0.6 sharp strategies. And the buyers know that, right? Like AQR is very clear. Hey, look, we're tilting into equity factors. Here's the long-term data. We can show you what the sharps are. And you want to know what? If value has a bad go, we're going to end up having a bad go. And that's exactly what happened. And then value rebounded, and they did quite well for a year or two. So I think it's kind of disingenuous for someone who tends, and this person, I've followed them for a long while, tends to have a much more high frequency trading strategy, to shit on a low frequency style premium fund that clearly is just trading with a very different sharp. Yeah, so that's just hard. Like, I think it's just an expectations management game.
Well, the way I think about it is you and I do a lot of like emergent portfolio construction properties when we're building portfolios. So to me, like, especially like if we're talking about managed futures, long ball, tail risk, or different, very specific niche strategies, it's when do they provide you with P&L? And that's more important, I think. And that's much harder for people to realize. And that's why I bring it up, because it brings it full circle back to Chaos Kings. So we're talking about like how nobody wants negative carry, right? Nobody wants this insurance of this tail risk, but yet nobody goes to their financial advisor every year and they look at the insurance costs of their house, their life insurance, their car insurance, and looks at the negative EV of that, or the negative Sharpe ratio. But it's about when does it provide you with returns. So related to that, what they clearly keep talking about Chaos Kings is that they say that Spitznagel and Taleb defined an entire asset class. Like, do you think that's fair? Not to put you on the spot. I'm just like, that's...
It might be. It might be. It honestly might be. Look, that industry, as I've come to learn, is pretty damn small. Like, as far as like
it's a tiny,
you know, they are a major player, both from an asset perspective and a brand perspective. I think, again, Black Swans being written 15 minutes before the GFC did more to make tail hedging a real industry than just about anything else. Now, I am an outside player. I don't know the full history. I'm sure there's someone who's inside that industry screaming about more important things. But from an outside perspective, yeah, I think they have done a tremendous amount to build the brand and the importance. I would say Taleb more than Spitznagel. I think people in the industry know Spitznagel. I think Taleb is more of a out there personality. I think, you know, he runs the Real World Risk Institute and all that sort of stuff. I think he probably draws more long attention. He's a bit more bombastic than Spitznagel is. And I think he's done a tremendous amount to draw the public's attention to this pretty niche concept.
Yeah, they're talking about it's all of his books, and then the auspicious timing luck too as well. But then combined with the chapter I was just finishing on is when they start into CalPERS. And to your point, what they were actually saying at the very beginning is, I think at the time, you know, CalPERS, you know, is managing their $200-300 billion or whatever it was at the time, and they're going to give them like a $1.5 billion allocation. But they don't care. Like, obviously, it's not going to protect against the overarching portfolio, which is, by the way, incredibly hard at mega size. I'm very empathetic to that. But what they're talking about is that gave validity to the institutional client and world that tail risk hedging is a thing. And so that was like, to your point, it's like that's when they're hitting their stride, is when it becomes an allocation that CalPERS is going to look into. And then there's going to be a lot of copycat or follow on the institutional level, because it justifies it. It's just like when you had the first, you know, institutions moving into Bitcoin, or quite frankly, when PTJ, when Paul Tudor Jones started talking about Bitcoin, all of a sudden it was a viable asset class for a lot of people.
You need someone big to legitimize it.
Yeah. So pivoting again, I was just in Tahoe. Was it last week? I can't keep track of time. Unbelievable event once again, where Shannon Staten from the collective puts on these great, you know, intimate events in great locales where we can all get together and talk about investing, and, you know, not necessarily with the compliance bird sitting on our shoulders. What is that? The compliance bird is an albatross, or should we cut that so I don't get in trouble?
I didn't say it.
But when I had our mutual homie Chris Abdul-Masih come up to Tahoe, and he gave it, I think, one of his first talks in the small group. He wrote about it on his wonderful newsletter, Moon Tower, if anybody wants to read it. He was, you know, nervous, but he did great as always. He's always underselling himself. But he brought up a couple of topics that, you know, man after our own hearts, it's going to be very interesting to us. One, you know, we always talk about this arithmetic versus geometric return. We talk about compound, and we talk about ergodic versus non-ergodic systems, all of this shit. And Chris just said it's reinvesting is how he thinks about his investing portfolio. Like, if you buy a cheap stock and you're buy and hold forever, does it really matter, right? Eventually, if the longer term you go, it's just going to hit the average. So he thinks investing is all about the ability to reinvest, which is just a simpler way of saying compounding. And that was like a light bulb moment for me that I'm probably definitely going to steal with him, speaking of attribution, and I'll just run with it, and then everybody can attribute it to me.
I think you should write a whole book about it called Reinvesting.
Yeah, that's what I was telling Taylor that this morning.
Exactly. I heard it from Jason Buck. So as far as I'm concerned, reinvesting is your concept now. I actually really like that framing. That's interesting. No one's put it to me that way. But yeah, whether you're rebalancing or whatever you're doing, right? Refreshing a portfolio is reinvesting in many ways. And I think that's a really interesting way of thinking about it. He is a phenomenal talent of distilling complex topics into a very simple to understand way, I certainly think he should teach something at some point. He would make a phenomenal educator. I'm not saying he should go do paid courses, but he really just has a talent. Should write a book or something. But yeah, if you don't know Chris, definitely look up his newsletter. Free to subscribe. Moon Tower is what it's called. Chris Abdelmasia. Really phenomenal stuff. One of the only things I read pretty religiously weekly of all the newsletters I get.
Yeah, part of it though, I think about this all the time with options, especially if we just use leap options, for example, like really long-term options, whether you're using 2-year leaps or you're buying OTC or buying 10-year leaps, is similarly to like value investing or buy and hold stock investing. Is like there's a bit of a Schrodinger's cat problem, right? What is that really worth? You know, like we're marking the market all the time, but especially with options, as you know, the pricing can vary quite substantially. And so that's the part about reinvesting, is a form of monetization and then reinvesting for that compounding. But like, so we know about the compounding side, but I was just thinking more about that Schrodinger's cat side of like, yeah, you expanded your P&L, but does it really exist until you monetized it?
Well, the way I think about it, right, that geometric compound growth, like G is approximately equal to your arithmetic expected return minus half the variance. So that's where the whole concept of variance drag comes from. Reinvesting, rebalancing, whatever it is, affects both those terms. So let me give an example. If you have a 60-40 portfolio that you just allow to drift over time because stocks outperform bonds over the long run, expected on average, what you would expect is that variance term is going to keep going up. It's going to go from a sort of halfway between stocks and bonds to eventually your whole portfolio is going to be 100% stocks, pretty much 0% bonds. Again, this is over 100 years. And that variance term approaches the drag of stocks. Now, your expected return may also go up because the expected return of stocks may be higher than bonds, right? But a lot of rebalancing and refreshing the portfolio is actually controlling that variance term. On the other hand, think about like factor investing. If you're buying a value portfolio, if you buy value stocks and you don't refresh that portfolio to constantly buy new value stocks and sell the stuff that's priced up, that expected premium of buying value stocks of outperforming the market will eventually compress to zero, right? So a lot of portfolio rebalancing, refreshing is about making sure you're maximizing the A and minimizing the variance drag so that your compound annualized growth is as high as possible.
And then you and I have had the argument ad nauseum that rebalancing premium, whatever you want to call it, works really well, especially we have high variance mean reverting assets. But if things start to trend, you can get a little bit hurt in that. And that's what people tend to point out is like the trend of like they're buy and hold that one stock out of 30 that really crushed it. And that tends to dominate the portfolio.
I think of these as being very different things, right? There is trading P&L that comes from rebalancing, that if you happen to rebalance on a cycle that is mean reverting, right? You can't just be a mean reverting asset. You have to like do it on the cycle of mean reversion, right? Then yes, you can capture P&L, right? So think of like a sine wave. People are always like, oh, let's say it's a mean reverting asset. Well, it doesn't fucking matter if you do it when it's always at zero, right? You need to sell the high and buy the low. You can't just always sell the average, buy the average, right? So you need to get the cycle right. And it's going to cut the opposite way if the asset is trending. So yes, there is a P&L that comes from the underlying assets behaving in a trending or mean reverting fashion. But what I would argue is regardless of that, there is the ability to constantly bring the portfolio back in line with the portfolio you believe ex ante has the highest compound growth rate because you're refreshing the arithmetic expected return and you're making sure that you're diversifying the portfolio in a way that brings the variance drag down.
And then counterintuitively, usually if you have an asset or asset class that has had an extraordinary run in P&L, you probably have a left skew to that. And you may be helping to truncate the left tail. Not necessarily going to work or guaranteed to work, but I think that's one of the counterintuitive things people don't realize is what could be a right skew when you got into a trade could eventually be a left skew trade, depending on how long that P&L is run on, right, or where that asset class is trading at.
So speaking of Tahoe, really quickly, I saw you were out on a boat, and I heard rumor that while you were out on the boat, you ran into some pirates who only agreed to let you go if you would fulfill their pirate pinky promise.
I can't believe it happened. I mean, it's unbelievable. And that's the only way we could get away with those pinky promises. And we had to,
so you want to
everybody on the boat,
tell everyone what had to happen?
Everybody on the boat locked pinkies with the pirate boat as they came, up along our broadside. And they made everybody on our boat promise that they would hit that subscribe button on our YouTube channel. Now, even the people, they said, look, even if I listen on audio, I'm going to jump off my audio while I'm listening. I can still log on to YouTube and hit that subscribe button. And they made us go one by one, and everybody had to promise to hit that subscribe button on YouTube. And then we unlocked pinkies, and we just slowly drifted away, and all was kosher and copacetic. So, I mean, we barely got rid of that, but that's what we asked from this audience as well, is that's our Pirates pinky promise to you, is you just got to hit that subscribe button, and we'll just keep creating this amazing content with at least one of us wearing a pirate sweater. So also at Tahoe, Chris was talking about this really helped me. And like every brilliant statement, it's a statement of the obvious that you just couldn't quite conceptualize before. And so, we've had these arguments about VRP and ERP, whether the voluntary risk premium or equity risk premium exists. And the argument I always hear that I hate is like, you should be paid for taking a risk over the risk-free rate. What Chris brought up...
We've had this debate before.
Right. What Chris brought up is, no, it's actually like a non-diversifiable risk. So the example he brought up is Pemex, the Mexican oil company, is every year or whatever, they're trying to hedge, the oil rate. And so they will now look at, like, Delta is the people that want to take the other side of the trade, because obviously Delta has the oil inputs as part of their cost, and they can cross both of their insurance needs at the market, right? And so this is an example where you have producers, manufacturers, real players are able to cross their risks. And then by doing so, there should be no risk premium to that, because they're both diversifying their insured risks. And then that lowers cost of capital or allows them to create a more profitable business. And then he brought up, if we're talking about like S&P 500 index, it's there's no true player on the other side, or producer or manufacturer. So therefore, you have to diversify that risk across many players and many institutions. A lot of times it goes from banks to hedge funds to kind of clear that risk. And that's why he believes there's always going to be a risk premium in volatility or equities. And you think, oh, no shit, that's a statement of the obvious. For me, that was a light bulb moment that like, that makes a lot more sense.
I don't mean to be an asshole. That is Finance 101.
Exactly.
I don't mean to be an asshole, but that is yes. But you should not be compensated for a diversifiable risk. Right? It has to be an undiversifiable risk for you to be compensated with the risk premium.
But then part of that though is, why does everybody always talk about then that the risk premium exists? Because you need to be compensated for taking excess risk above risk-free rate.
Because if it's undiversifiable, you can't get rid of it. So you're wearing the risk. So why would you accept the risk-free rate of return for something that now you have risk, right? If I say to you, Jason, I'm going to give you 3% to hold a rock, or I'm going to give you 3% to hold a bomb, and you're like, and you can't get rid of the bomb, and you have to hold the bomb, and maybe it'll go off, maybe it won't. You're not accepting that trade. You're taking the 3% for the rock. You're going to go, no, I need 10% for the bomb because it might go off, right? The point is, you would not accept anything less than the risk-free rate by any means, and you need something more than the risk-free rate to get you to move off the risk-free rate. Because otherwise, like, you'd be like, why would I take any risk?
Right.
I would just buy these government treasuries that the U.S. is never going to default on, and we're never going to have any debt ceiling issues ever in the future. Ever.
So the other that's likely Finance 101 thing I'm having a hard time wrapping my head around is that if everybody in the market hedged that risk, even though it needs to be non-diversifiable across all actors and players, would then we just reduce like that to the risk-free rate?
How can every player in the market hedge the risk?
That's what I'm saying. Theoretically, if everybody hedged the risk,
but it's so it's not possible, right? So you couldn't theoretically have everyone hedge the risk, because someone's gonna like that. That equity exists, right? On somewhere. So if I'm long all this equity in the market, how do I hedge the risk? I have to short someone else's shares, but they're long. I don't know, maybe you could circularly short everyone else's shares, but then no one actually owns anything.
That's what I'm saying. If it's
Right?
theoretically possible to do that, the no arbitrage condition would mean that there was just zero return, right?
Well,
In
you
a
get the
closed
risk-free
loop
return,
system,
right?
or the
You
risk
get
free,
the
right?
risk-free
Right.
return.
That's what I'm
Right,
saying.
so-
Like if that was theoretically possible a closed loop system, but then it's not a closed loop system when we have all these other ancillary benefits to like hedging that risk or taking different positions, and we have to look at everybody's overarching
Right.
books.
I think the only way
perspectives.
you could all hedge it out is if everyone sort of like did the circular thing that I talked about, which is
Right.
kind of weird to think about. I mean, I don't think you could do it with like derivative instruments necessarily without it coming back to that circular argument. But yeah, like one of the things I talk about in my writing is that there are limits to diversification. You cannot ultimately get rid of risk through diversification. If you've eliminated all the risk in your portfolio, you've effectively created a very expensive risk-free rate or an arbitrage or very true alpha
or a Madoff.
Or a Madoff. Yeah. So I think these are one of those things like people often go looking for that perfectly smooth equity curve. And I'm of the opinion there are very, very rare instances where that is possible. And I'm not saying there aren't cases where you can't actually manufacture an arbitrage. It certainly exists in more fragmented markets. There can be information asymmetries. Like I don't believe markets are efficient by any means. But when you're talking about S&P 500 stocks and big liquid market cap stuff, I think there's a lot of like limitations to the diversification at the portfolio level.
And then almost like we were talking about like the Pemex and Delta is like as I was saying, outside that closed loop system is you have the open loops of like you have other conditions where it may be reducing your cost of capital or increasing your profitability that's not expressed in like the financial markets. And that's part of it too, is like everybody has exogenous reasons why they're doing something as well that are not coming to play in the marketplace. The other thing, Chris Abdul-Masih, obviously man after our own hearts, he just totally dismantled alpha in one of the talks. And it was a lot of the things you and I have been talking about for the last year plus of like the things that we love is like, if there's truly alpha that can't be, expressed via beta, then no one can understand it. Right. And as we deal with investors, no investor wants to invest in anything they can't understand. And then he's like, and then if that does exist in that alpha, let's just say Rentec was able to do that or whatever, they were going to charge high enough fees to make sure they capture all the alpha as a firm. And you're not, one, going to get access, or two, if you can get access, your fee rate's going to be so high. So he's just like destroying the entire idea of alpha. Like, even if it exists, you can't access it anyway.
I hate the phrase alpha.
Right.
I hate it because
you brought it up earlier, though.
It's amorphous. I mean, like,
yeah.
Let's just go back to where alpha comes from. It's from a fucking linear regression, right? It's from CAPM. Like again, finance 101 stuff. The return of the portfolio minus the risk-free rate equals alpha plus beta times the return of the market minus the risk-free rate. And then you run that regression. And it wasn't like alpha and beta were chosen to mean something special in finance. That's what they're called in a goddamn linear regression. These are your betas. These are your factor loadings. Like that's just what it's called, a factor, because that's what it's called in a regression. Like these weren't special terms to finance. And this idea, alpha is just what's the intercept term? And alpha doesn't work when you're looking at returns that are not linearly related. So convex stuff, it's totally broken as a measurement. But it's ignoring the fact that there's going to be all these unexplained residuals, right? That's what these multi-factor models try to do is explain the residual terms. But like you have this constant alpha plus this noise term. Well, that should probably get smushed together into some sort of random variable to recognize your alpha. Actually, there's all this idiosyncratic noise that goes with it. But yeah, I think there is this conflict as well. I actually disagree with Chris that that someone like a Rentec, if there's enough alpha, that they are going to set a fee high enough that they harvest all the alpha. Because I actually think that's short-sighted.
Or what they will, also, go ahead. Sorry, go ahead.
Because you know what's a much better alpha than earning alpha? Client fees. Right? So what you really want to do is find the market clearing price at which you can still deliver alpha at the highest maximal fee level. Because as an asset manager, then you can raise as much money as possible and get a very consistent return stream, right, from client fees because it's not your money anyway. You don't get to keep the alpha. Like that's where Chris is wrong. Like you can't run client. Like you need the fees to get the carry, and you need the clients to stay in there for you to earn the carry. So it's a market clearing price thing. I think Chris is absolutely wrong on that.
Well, I actually, in fairness to Chris, I think he did talk about the nuance on there. It was like, how much can you charge and still get away with? And
by the
like,
way,
so
I like that I'm saying Chris is absolutely wrong, and I wasn't even
wrong.
there for what he said.
It wasn't even there.
In the
wasn't
game of
even
telephone,
there.
Chris is wrong.
So, and then, the other thing he talked about that was a man after your own heart of what you and Zed were arguing with me at the Thai restaurant in Vegas is about. He's also like, if it does exist, it's so capacity constrained as well that you're never going to get access either. Like they're just going to run their own money. Like, and to his reinvesting principle, it's capacity constrained, so you can't reinvest either. So you're just taking it cash out. You're just getting, cash flow.
That is absolutely true, and you see that. I've seen that with high frequency firms. Like they have unbelievably high sharps, but it's like, I mean, I saw this with some crypto people I know. It's like, great, we can run $1 million and we can make $1 million a year, but we can't now compound it 2 million. It's like we're constantly making $1 million, which is fantastic, but it's like you don't get to compound it. Look, you see that with Rentec, right? They have this secret fund that runs at a sharp of 5+ that's closed, and it's money of the firm employees only. And then they have their public fund that, it looks like sort of your average quant fund of 0.5 sharp type stuff. Like it's just, if you want to run uncapacity constrained, there are inherent limitations to the types of strategies you can run.
Yeah, and I don't want to dox anybody, but there's a well-known like kind of quantish firm out of Chicago where like they're just spitting off like $150 million a year in P&L, and they're capacity constrained. But like, like everybody likes shit on that capacity constraint. But I don't know about you, but I'd take 150 mil just spitting off cash flow every year like clockwork any day.
Absolutely.
Oh, so one other thing,
maybe we're just crazy.
One other unique thing that happened up at Tahoe that I think you'll love, and shout out to Shane Zhang for having this idea, is the idea of he was talking about how to take advantage of the AI, and how do you invest in or take advantage of it. And once again, a lot of people are talking about fundamentals and everything, and Shane was like, no, there's this company, and I might get it wrong, like it's 3Q AI, but their ticker symbol's AI. So he's like, retail is just gonna ape into this AI ticker. Just like they did the wrong Zoom and the wrong Peloton, like back in 2020. And I was like, I knew that would get you thinking about that one. And our mutual buddy PJ pointed out like AI, the ticker's already up like 500% in the last 6 months. And Shane's like, fair, but like what he's looking for is in the subreddits, when those people really start posting their P&Ls, is when you see retail really go into it on the subreddits. And I thought you'd like that one.
I love that one. I love that one a lot. What I also find fascinating, so you remember that the Zoom mistake,
right? Yeah.
Right. What I think is particularly fascinating about that stuff is you see those pops and you would go, okay, like the people who made the money or the people who put their money in and realized it was the wrong Zoom, like you would expect it to collapse immediately after, and you don't actually see that. Like you have this weird pattern in markets where things go exponential, and then they never exponentially go down as quickly. They tend to like go exponential and then drift a lot more slowly down. And I've never found a good answer as to why. Part of me wonders if it's just like arbitrage constraints in a way that it's hard to short, or the cost of shorting is super high, or people aren't selling out as fast. They're going, oh, it started to go down, but maybe there will be another pop, and you get less sophisticated investors. I don't know what it is, but you see this pattern over and over and over again, and I've never really found a great answer as to why it exists. So it'll be interesting to watch something like AI. I know nothing about the ticker. Maybe there was some fundamental reason it's up 500%, but you definitely see these very weird cases of like that is totally unrelated. Someone did misclicked a ticker. It caught on. Dumb people follow dumb people. Dumb flow follows dumb flow. And sometimes it's dumb flow thinking that they're being smarter than other dumb flow, right? It's like knowingly dumb flow of playing like musical chairs or whatever, but it's all zero sum at that point.